If you're an accredited investor, you probably already own a mix of stocks, bonds, and maybe some real estate, including real estate investment trusts. So the question is, how does the Investor First Fund actually compare to what you already hold? I want to answer that question because the fund is not designed to outperform all of these. It's designed to deliver something different from all of them. The Investor First Fund is an alternative investment available only to accredited investors. At its core, it is a fixed income product built for stable, predictable monthly income with downside protection and diversification away from your traditional holdings. Let me compare it to 4 things you likely own one at a time. Let's start with bonds, because bonds are the closest comparison. Like the Investor First Fund, a bond is a debt instrument, and it is where a lot of safe money goes to earn income. Here's the key difference, though. Most bonds carry a fixed rate, and their value moves with the broader interest rate environment. When market interest rates rise, the value of existing bonds falls. When market rates fall, bond values rise. So even though a bond is meant to be a safe fixed income holding, the value of the bond itself is exposed to interest rate swings. The Investor First Fund is built to avoid that. Movement in market interest rates does not move the share value of the fund. And the reason comes down to how we write our underlying loans. Our loans are written at variable rates set at prime plus a margin. So if our loans are producing somewhere between 10 and 12.5%, that rate is really the prime rate plus the margin needed to get there. Here's the important part. Every loan also has a fixed floor, set at the rate when we close it. Let me give you an example. Let's say the prime rate is 7% and our margin is 5% for a total rate of 12%. The loan document set a floor at 12%. So if prime later drops, our rate for our note stays at 12% for the life of the loan. But if rates rise, the loan rate rises with the prime rate. That means our investors have it both ways. A hedge against rising rates because the loan rate climbs, and a hedge against falling rates because the floor holds. That's a meaningful advantage over bonds. Next, let's talk about real estate investment trusts. On the surface, a real estate investment trust, or REIT, looks similar to us. Both produce regular monthly income. We earn ours from monthly loan payments. A REIT typically earns its income from monthly rents. Depending on target returns, the income side can look fairly comparable. The real difference, again, comes from value fluctuation. Because of how the fund is structured, the Investor First Fund is largely insulated from value swings driven by the interest rate environment. A REIT is not. The underlying real estate a REIT owns can move significantly in value, both with interest rates and with the broader real estate market. Now, in a rising market, that's a benefit to a REIT investor. You get the income coming in and you get the appreciation of the underlying assets on top of it. However, it cuts both ways. When real estate values fall, the value of your REIT shares fall with them, and we have seen exactly that since 2022. In a rising rate environment, capitalization rates have climbed sharply, and the underlying values of multifamily, commercial, and retail assets have fallen significantly. So a REIT investor may still be collecting steady rent income while taking real losses inside the portfolio itself. The Investor First Fund is different. Yes, the value of the fund can be affected by falling real estate prices, but there's an equity buffer built into every loan we write because of our conservative loan-to-value ratios. Our maximum is 70%. When you buy into a REIT, you're buying at the full market value of the underlying real estate. So, if that value falls, your share value falls right along with it. In our fund, real estate values would have to fall by roughly 30%, eating into the borrower's equity first, before investors would see a loss from declining values. That buffer is the big difference between REITs and the Investor First Fund. Now the stock market. Let me be direct. The stock market can produce far higher returns than the Investor First Fund. We're not going to pretend otherwise. But the fund is not designed to chase the stock market returns. It is designed to reduce volatility in your portfolio. The stock market is famously volatile, and it's said that no one really knows why stock is up one day or 1 week versus the next. You can have years where everything goes up and years where nothing works at all. The Investor First Fund is not built to compete head-to-head with that. It's built to be a steadier, safer ride alongside it. A place for the part of your portfolio where you want predictability instead of swings. And that brings me to dividend stocks, specifically because they are the closest stock market comparison. A strong dividend stock can pay income that is roughly equivalent to what the Investor First Fund produces. There are moments when a dividend stock is a great play. For instance, when its price has fallen and you can buy it at a discount, which raises your effective yield. But notice what is happening there. You get that higher yield because the stock's value dropped. You're taking on price volatility to get into it. The Investor First Fund is designed not to have those underlying principal fluctuations, whether you're talking about common stock or a strong dividend payer. It is simply insulated from that day-to-day market volatility. I want to be clear about what I'm not saying, though. I'm not saying that the Investor First Fund is superior to the stock market, the bond market, or guaranteed products like CDs and Treasury bonds. Every one of those has a place in a portfolio. What we have built is a specific combination: strong yield, real downside protection, and low volatility. We do this by insulating the fund from the variables that move the value of the investments you already own. From rising and falling interest rates, from falling real estate values, and from the week-to-week opinion of the stock market, we have designed a safe haven with strong, predictable returns, a steady place for the part of your portfolio that you want to simply perform month after month without surprises. If you'd like to see how the fund might fit alongside what you already hold, you can reach us at stallioncap.com.